good morning everyone. I take this opportunity to thank ICICI Securities for hosting the call today. I hope everybody had an opportunity to go through our investor presentation and press release uploaded on the stock exchanges yesterday. We have also uploaded the Excel fact sheet on our website. With me today I have Mr. Rupinder Singh, MD and CEO, Mr. Ashish Gupta, CFO, and myself, Rahul, Head IR. I now request Mr. Rupinder Singh, our MD and CEO, to brief you all about the company's performance. Thank you and over to you, sir.
Thank you. Very good morning, everyone. On behalf of the India Shelter Finance Corporation, I extend a warm welcome to all of you. Thank you for joining us on the call today. For the company, the year financial year 24 has been gone well. We have been able to maintain our investments in branch, people, and technology to help us grow sustainably. We have been able to navigate well during the rising interest rate cycle, and maintain our margins, yields, and profitability as per the plan. Moving on to the results for the quarter, we are pleased to report a good quarter. AUM stood at rupees 6,084 crores, which grew 40% year-on-year and 8% quarter-on-quarter, driven by a disbursement growth of 10% quarter-on-quarter to rupees 747 crores. Full year disbursements stood at rupees 2,646 crores, registering a growth of 35% year-on-year. We continue to deepen our presence in the location we are present in. We added 40 new branches during the full year and 8 new branches in the quarter, totaling our presence to 223 locations in 15 states at the end of financial year. We continue to source internally with in-house sourcing at 98%. Moving on to the liability side, liquidity pipeline is very strong with positive ALM. The company has access to diversified and cost-effective long-term borrowings. Our rating upgrades have been consistent over the years. During the quarter, India Rating and Research assigned us our rating to AA- stable. In terms of asset quality, 30 plus improved sequentially to 2.4% from 3.5% and continues to be stable on year-on-year basis. Gross stage 3 and net stage 3 improved to 1% and 0.7% respectively as of 31st March 2024, as against 1.1% and 0.8% as of 31st March 23. Well, our expectation for the year continues to be the same what we indicated last time. Point 1, branch addition of around 40 to 42 for this year, maintaining the spreads at around 6%, credit cost of 40 bps, and loan growth what we expect is again tune of 35%. Now I would like to hand over call to Ashish Gupta, our CFO, to take you through the financial metrics. Over to you, Ashish.
Thanks, Rupinder ji. Good morning, friends. Let me take you through the key financial numbers. Total income for the quarter is up by 38% year-on-year basis and 12% upon quarter-on-quarter basis. Total income for FY24 is at 861 crore, up by 42% year-on-year basis. Portfolio yield is at 14.9%. Year-on-year it is up by 20 basis point. Quarter-on-quarter it is up by 10 basis point. This is primarily driven by improvement in our disbursement yield for FY24, which is at around 14.9%. We have diversified source of borrowing with more than 30 counterparties. Our cost of fund quarter-on-quarter is stable at 8.8%. Year-on-year it is up by 10 basis point due to increase in market interest rates. Our marginal cost for FY24 is at 8.6%. Share of NHB funding is at 15%. We have undrawn sanction of 210 crore from National Housing Bank to be utilized in Q1 of current financial year. Our margins for the quarter is at 6.1%, which is in line with our guidance of 6% for the medium term. Net income for the quarter is up by 40% year-on-year basis and 18% upon quarter-on-quarter basis. OPEX for FY24 has grown by 30% against 40% growth in our AUM and 42% growth in our income, resulting in operating leverage. OPEX to AUM in Q4 is at 4.4%, year-on-year down by 30 basis point. Cost to income for the quarter is at 38%, year-on-year down by 200 basis point. Credit cost for the quarter is 40 bps in line with our guidance. Sequential uptick in the credit cost is on account of our policy to write off old age NPA accounts annually in the March month. DPD 30 is at 2.4%. Year on year it is stable. Our stage 3 assets are at 1%. Year on year down by 16 basis point. Our provision coverage ratio for stage 3 assets is stable at 25%. PAT for the quarter is at 78 crore, year on year up by 47%, quarter on quarter up by 25%. PAT for the FY24 is at 248 crore, year on year it is up by 59%. ROA for the quarter is 5.4%, year on year it is up by 30 basis point, quarter on quarter it is up by 70 basis point. Our ROE for the quarter is 13.8% at a leverage of 2.5 times. ROE for the year is 14%, up by 60 basis point year on year basis. With this, I conclude, and now we can open the floor for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask question may press star and 1 on the touchtone telephone. If you wish to remove yourself from question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for the moment while the question queue assembles. First question is from the line of Concall from Citigroup. Please go ahead.
Yeah. Hi, sir. Congratulations for good set of numbers. So firstly, if we have to look at it overall in terms of the NIM trajectory, so given that larger part of the growth has come with respect to interest on loans, so just broadly I want to gauge in terms of what has led to, I would say on a calculated basis it comes to like more than 40 bips kind of increase out there. So what would have ideally led to this kind of rise, and how much of this is sustainable? Maybe in the other line items, obviously there would be an element of IPO funds, but interest on loans, just broadly want to get the delta on a quarter-on-quarter basis.
Thank you, Kunalji. If you see, yes, there's an impact of IPO, equity, and again along with that, if you see that our spread, what we are maintaining in the tune of the guidance as given earlier, of around 6%. This time it was 6.1%. Yes, focus was there on the ground and we sustain ourselves. If you see going forward, what changed the trend? We feel that we are in position to maintain it to the level of 6%. That is the perseverance which we want to continue in coming time also.
Yeah, but in terms of any rate action, anything was there which would have led to this?
So, Kunalji, our most of the book is on fixed rate of interest.
Yeah.
So for the new customer, which we are acquiring, yes, we have ensured that we have this uptick for giving the rate as per the spread of 6%. But for the rest of the customer, we have not changed in this quarter anything.
Okay, nothing is changed. Yeah. Okay. And secondly, overall with respect to the ECL provisions on AUM, that's maybe marginally down. No doubt there is an improvement on 30 plus as well to 2.4. But what would be the levels wherein we would be comfortable? Would we want to make some provisioning on the stage 1 and take that or keep it at somewhere around 1% odd, or would that be the indication, or we would be comfortable at this levels looking at the collection efficiency and the trends in GS3 and GS2?
So given the strong recovery trend in this affordable housing finance space, we believe that stage 1 asset provision will remain around 40 to 50 basis point as a percentage of stage 1, and stage 3 assets provisioning will remain around 24% to around 26-27%. You will see marginal improvement in our LGD. Last year it was around 26%. This year it is around 25%. This is primarily on account of improvement in the recovery trend that we have seen in this particular year. That's why it has improved. Our PCR has come down from 26% to 25% this year. It will remain broadly in the similar range.
Okay, so we will keep it around 24 to 25. No plans to take it to 26, 27 and overall ECL to somewhere around 1% odd.
Yeah, it will remain in the range of 24 to 27%. And if you look at ECL as a percentage of AUM, it is also a function of your stage 3 asset proportion.
Yeah, I agree.
Our stage 3 proportion has come down. That's why you are seeing marginal dip in ECL as a percentage of AUM.
Sure. And write-off would be hardly 5 odd crores, no? During the quarter, 0.1 odd percent.
Yes.
Okay. Thank you. Thanks and all the best. Yeah.
Thank you. A reminder to all participants, you may press star and 1 to ask question. The next question is from the line of Umang Shah from Kotak Mutual Fund. Please go ahead.
Hi, good morning. Thanks for taking my question and congratulations on a great quarter. Just a couple of things. One is on the yield front, just continuing from the previous question. Now I do understand that at this point of time, I mean, you have been able to hold your spreads and yields per se. But let's say if we were to look at some of your competitors who have reported numbers, obviously slightly larger in terms of size, are somehow witnessing some bit of pressure on yield. So maybe more from a medium term perspective, how should we look at this whole dynamics between your AUM mix, your yield, and also if you could just give some perspective from a competitive intensity perspective, that would be really helpful. Thanks.
Yeah, thank you, Manji. Frankly, we are able to hold this yield. What we are looking is majorly on the focus on direct sourcing, which is 98% for us, which is in-house sourcing. So this gives an insight that instead of depending upon third party, you give a better service turnaround time to customer, and then automatically this can be maintained in that sense. Till now, if you see, our fixed rate book is around 83-84%. There for the new customer, we always maintain that spread has to be 6%, that we keep maintaining even during the last call and even now what we explained around that side. In future also we want to maintain from short to medium range. This is the point which we always keep in mind. So first, always being a self-sourcing, which is in-house, that we continue to work around that side and keep improving on the optics on that side. And secondly, maintaining the 6% of yield. In case if there is a trends coming down in terms of cost of fund in coming days, we would still like to pass on to customers and maintain the same level of 6%. So our objective is to stick to the optics that we are revealing out basically.
Okay. And understood. Sir, the second question was more from your overall profitability perspective. Now, clearly, at this point of time, there are some tailwinds, given that the leverage on the balance sheet is lower. We just recently concluded an equity raise, so our reported ROAs are looking, surely healthy. Now, as we scale the balance sheet over next 2 to 3 years, where should be the more steady state sort of ROAs? And also from an OPEX line perspective, I mean, clearly, I mean, our exit quarter OPEX ratios have been lower compared to our full year averages. So how should we look at, again, the whole mix between margin OPEX and eventual ROAs? Yeah.
Umangji, you understand this business is a long-term and business of longevity. And what is important in this business is a largely persistency. If we see on the OPEX side, this is something which has to keep coming down as the time progresses, because most of the costs, whether the tech costs, other things have been already absorbed. We are already available in 15 states, and what we need to do is penetration in these all states instead of spending somewhere else. So this is one optics that we have a focus on. Mentioned during the last call also, we would like to reduce this OPEX to AUM by another 15-20 bits as the year gets progressed by end of the year. So that is one thought on that piece. If you talk about ROA per se, this is an advantage as of now. But on a focused and sustainable pace, we always projected and pitched ourselves. This is going to be the tune of 4%. So 4% of ROA from current level to say mid-level whenever say the coming times. So this is which we are going to maintain it. So OPEX side, yes, there will be a decremental as the time progress, and on sustainable basis, 4% you can assume around.
Understood. Sure. And just last question is on our cost of funds. I believe last quarter is when we got our rating upgrade. Has there been any meaningful benefit which has started coming through on a marginal cost of fund basis, or broadly that is kind of already built in, and we should not expect a material improvement in our cost of funds going forward?
We have, just got our rating upgrade in the last week of March 2024. So we are in discussion with our lenders for our fresh funding as well as reduction in spreads for our existing borrowings. But discussions are since it's just a month since we have got this thing, so discussion will materialize over the period of time, and we expect that 15-20 basis point improvement in our cost of fund by end of this financial year.
Okay. All right. Perfect. Thank you so much. Those were my questions, and wish you all the best.
Thank you.
Thank you very much. The next question is from the line of Nischint Chawathe from Kotak Institutional Equities. Please go ahead.
Is without any assumption in interest rate changes, or are you assuming that interest rates come down towards the second half of the year?
Nischint, can you just repeat your question?
Yeah. So, Ashish just mentioned that we are looking at a 15 to 20 basis point improvement in cost of funds. Now, is this driven by rating upgrade, or are you also assuming that interest rates come down in the economy towards the second half of the year?
So this is assuming the stable state of interest rate environment. So in case interest rate repo rate come down, then obviously the benefit will be larger.
Got it. Just a little bit on growth. If you guided for around 30-35% growth. So if you could spell out a little bit more descriptively in terms of how much growth we are looking at from existing branches, SSG types growth, and how much is because of new branch addition, and maybe a little bit of an annual plan for branch spread out that you will do in this year. Sort of a little more qualitative color for us to understand.
Yes. So, recently, we are present in 15 states, and we were planned to open around 42 branches in this financial year. And these branches will be staggered across the quarters. It is not at a particular point or something. Every quarter, there will be additions of 8-9 branches. That way, we want to sustainably go up. The new branches, definitely, when we open them, they have a certain gestation time to reach a certain number. Vis-a-vis for the existing branch, there is always a productivity drive. So this productivity drive is on basis of the current set of people, what the numbers they have to produce. If the branch is performing well, then maybe we have to add a couple of more relationship officers in that way, right? So it's not a 30-35% is not because of one single agenda. It has to be multifaceted. One is branch opening, which I mentioned 42 branches in a year. Secondly is the productivity drive, which we keep harping on. And in case wherever we find the market is quite bullish, we can add resource in those particular branches also. So this way we want to build up. On these three parameters, which we confidently are able to produce the numbers in last many years, and we want to sustain on the same metric same way.
So let me put this differently. What is the typical AUM or disbursement target for a branch manager?
So if you see, we don't give a target on an AUM basis for the branch because it's a continuous business, and if you reach a certain level, then you realize that this AUM has been achieved maybe before time also in many cases. So what we give a target is on basis of what is the branch sustainability in number of files what they can process. So any branch, if that reaches to 16 to 17 disbursement in a month, there we feel that this branch has reached the pinnacle, basically. On an average, if we see the number of branches, what we have today, the average unit what they are disbursing is in tune of 11 to 12 units in a month. So any new branch will start with a, humble number of 6-7 units. Eventually it starts moving and reach to the level which is mid-range level of around 11, 13 units. And eventually when it reaches to the pinnacle, it goes to the level of 17, 18 units. Once it reaches to 17, 18 units, then it's the time to focus on that branch and maybe segment into two pieces so that, the numbers can be accordingly set with the next level of division. Ultimately, all these process, all these file, output has not to be dependent upon sales team, but also the processing team, basically. So without having an undue pressure on that set of the teams and getting the right output, we believe 17, 18 units is the maximum which we try to produce from one branch. So any market geography which gives the right output in that direction, then we try to further penetrate it by adding one more branch in that near vicinity. So this way, these are the three important levels. The first level, the starting level, the second level, the mid level, with 12, 13 units, and the next level, which is the wish list, which, not, all the branches take up immediately, but, substantially with time it grows, is a 17, 18 units per branch, basically. That we try to achieve.
And how long is the journey from 5, 6 units to 17, 18 units? Is it like 4 years or?
So, again, it depends upon geography, market response, our resources. But what we have seen averagely, the branch becomes sustainable to the level of, 11, 12 units in the year of around 1.5 years approximately. And another 1.5 years of journey reaches to this level of 16, 17 units particularly.
Got it. If I look at the repayment rates, there was an expectation at the beginning of the year that because of withdrawal of CLSS, the repayment rate would go down, and I guess that's visible in some of your peers. So, for us, it's almost been stable. So, is it something that the BT out rate has gone up this year, or is it something that repayments have been higher this year?
In fact, our repayment rate has improved by about 3% as compared to the previous year. Earlier it was, higher in the range of around, if you look at this as a percentage of opening AUM, this was at around 22% in FY23, and at this point it is around 19%. So there is 3% improvement, and 2% is driven by the withdrawal of the CLSS, and 1% is on account of our reduction in the BT rate in this particular year. So BT rate last year was at around 6.5%. This year it is around 5.5%.
Okay.
Nischint, this answers your question?
Yeah, I think this answers my question. Thank you very much, and all the best.
Thank you.
Thank you. A reminder to all participants, you may press star and 1 to ask question. The next question is from the line of Raghav Garg from Ambit Capital. Please go ahead. Yes, Mr. Raghav, you can go with the question.
Yeah, hey, sorry, I was on mute. Thanks for the opportunity. I don't know if this question has been asked before or not, but if I look at your NHB funding, that's about 15%. Do you plan to take this up? Because generally, when we look at other affordable housing finance companies, they tend to operate somewhere around 20-25%. So to that extent, would you say that you have room to increase this share, and how would you look at ramping up your NHB funding over a period of time? That's my only question. Thank you.
So at this point of time, we were having around 15%, as you have rightly said, and on top of that, we have around 210 crore of undrawn sanctions, which we will draw in Q1 of this current financial year, which will improve the NHB funding ratio. And further, just to emphasize here that NHB funding ratio is also a function of your credit rating as well as your scale. So as we have got a rating upgrade as well, So we expect in the coming time, we should be able to improve the NHB funding ratio further to around 18-20%.
So I think you had guided for a 15 to 20 basis points reduction next year in cost of funds. Does that assume that you would increase your NHB funding to 18-20%?
Yes. So it is a blend of both. The reduction that we get on our new funding as well as increase in the proportion of NHB funding.
Okay, so that cumulative benefit would be around 18 to 15 to 20 basis points. Right. And at what rate would you be drawing your NHB funds? That's one question. And another one is, what is the share of affordable fund within this total NHB pool that you have?
So out of the total NHB pool, we have affordable housing fund to the tune of 50% earlier, but now we are seeing some reduction in the from the government side or from the NHB side in this affordable housing pool. Earlier this used to be around 50-60%. This has come down to around 30%, 25% this particular year. So earlier the spread between the regular borrowing cost and the NHB fund was around 200 basis point. Now this spread has slightly reduced to around 150 basis point.
So you're essentially saying that the allocation from the government has reduced towards the affordable housing fund. Is that what you're saying?
So it is, again, cannot be assumed that this has been reduced from the government side. It is something that they have to plan and, impute. Sometimes it goes to the level of 50% and accordingly sometimes it also comes down basically. So there is not some kind of precedence that we can think of that will start reducing or things in that direction. There are expectation of schemes after, this elections get over. So what that comes, I think it is still under discussion. So it can go, either way in that sense. So assumption will be difficult to create out of this answer what Ashish has given.
This is a part of annual budgetary exercise of the government. So so we'll see how the budget for this year goes once this election will be over.
Understood. Thanks a lot. That's all from my side. Thank you.
Thank you. The next question is from the line of Sarthak Malhotra from Think Investment. Please go ahead.
Hi, I just want to check, is there any plan around the mix of LAP and affordable housing or just the home loan? Because LAP seems to be a little bit on the high side.
So our home loan LAP ratio is broadly stable at around 58-42%. 58% is housing loan and 42% is LAP. And just to reiterate from the principal business criteria perspective, we keep selling our LAP portfolio to banks in the form of direct assignment transactions, which help us maintaining our on balance sheet HL LAP ratio in a much better fashion. So at a balance sheet level, our home loan ratio is more than 70% and LAP is close to 30%.
Got it. And can you give me some update on how the co-lending piece is progressing?
So co-lending is something which we have started last year in the month of March 2023. Over the year, last 12 months, it has seen, some good shape. We have been able to disburse around 150 odd crore of funding in co-lending. And, this number may improve in the coming time, but this is an evolving subject still. We are still working on, couple of things and we'll see some, uptick in this co-lending volume in the coming years.
Sure. Thank you.
Thank you. The next question is from the line of Sanket from DAM Capital. Please go ahead.
Yeah, hi sir. Congrats on strong set of numbers. My question was on in-house sourcing. So 98% of the sourcing is in-house for us, and maybe say to reach a certain size of AUM, we can continue this 35% AUM CAGR. But some of our peers, not having the alternate sourcing channel, have faced difficulties in terms of growth after reaching a certain size. So are there any thoughts there, maybe not out and out underwriting from, say, corporate like DSAs, but individual DSAs or connectors, which some of our peers use? Is there any thought process to tap that sometime in future, or how you think on those lines to keep up the growth, say, even after we reach a certain size or certain threshold?
Yeah, thanks, Ankit. Actually, point is, the joy of this business is more into evolving in a fashion which brings some innovation around that side. So instead of doing what market is doing, India Shelter always needs to be a little focused on the tech side. And I think on the field we always have this prerogative to get the best output by ensuring ease of doing business at the field side basically. So when we put our resources, give them a right technology, right equipment to operate in market, they become more confident, and that ease of doing business helps them to score better in the market sense. I think our more prerogatives are more on improving the productivity at that level instead of focusing on the third party channels and all. That channels are anyway always available. They were available in past and future also, right? And it's more on a trade-off basically what you want to focus on. We believe that this is something which we want to create a niche around for coming times also. Giving that choice is always available. So, that's not something we have a focus as of now. So if it has to be come up, I think that is not in very part of plan immediately as of now.
Sure, sir. And lastly, on this stage 2 plus stage 3, which currently 30 DP plus DPD is around 3.2 for us, you think it's a steady state number, or where should we put our hooks on in terms of seeing this number on a sustainable basis?
So, so at this point of time, we have around 2.4%, which is in line with our last year. But if you see the, journey of last year, that will give you enough indications that, our DPD 30 remains in the range of 2.5% to 3.5%, largely during the year.
So there are some seasonality factors. But when you see year on year, we know that this is very well in controllable things around that side that we are putting again and again. So if there are any seasonality factor or whatever it is not our collection teams are very well entrenched in field. All 400 collection resources are available across these 220 branches. And we have a good control on that side.
Okay, sure, sir. Yeah, those were my questions.
The next question is from the line of Bhavik Dave from Nippon India Mutual Fund. Please go ahead.
Yeah, hi. Good morning, sir. Congratulations on a good set of numbers. Sir, just one question. And you alluded to your BT rate or BT outs coming down from 6.5% to 5.5%, if I got the number right. I just wanted to understand this trend, right? And if you could just elaborate a little more on what is leading to this improvement. Is it we are offering lower rates to these customers and getting them on board or not letting them go? And what is the process that we are following to keep this pool, indicating this pool that we understand that they want to go for a BT out and we're trying to curb them? So interest rates, top-ups, what are the 2-3 top reasons that we are able to help the customer with or services in some form that helps the customer to stay back versus beating out? So you can just what led to this improvement and how can we do this consistently over the next couple of years?
So BT rate normally, depends how the market rate trends are there basically. So last couple of quarters, there has been always a trend which on upper side. So people don't like to go out just, getting a top up or something like. They also look for a interest rate cut in one way or other way. So if interest cycles are going up, then automatically BT rate also comes down. That is an important piece. On the other side, if you are going deeper markets, which are tier 3, tier 4, there you'll obviously find that BT rates are lower than the larger markets basically. So as we are penetrating the current set of markets where we are operating it, So the BT rate will have this trend where, they'll not go substantially as it goes in the larger market around that side. Otherwise, these are set of customers. Normally they go for BT after a certain times where, they feel that it's a time to take a top up or maybe a very large rate deep cut, which is not a trend as of now, basically.
Sure. And if you could just highlight where these customers go to, are these smaller NBFCs or HFCs, they try to be aggressive and take our customers, or is it like more banks, HFCs? Where are these customers beating out, if you have a trend of these 5% odd customers that go out?
So this includes public sector banks, which are spread across country. People, once they have a good track record, they start filing ITRs regularly, and they reach to a level when they realize it, that they can a decent rate cut. They approach to the public sector banks also. And in few of the NBFC who are quite aggressive on the NTB side, they look forward that if they are getting a very, large chunk of top-up around that side, they also go there basically. So we see for us, the top 5-6 institutions who do the BT for us, that includes PSBs and a few of the large NBFCs on that side.
Last question on this is, at what vintage does a PSU bank or a aggressive NBFC come to? Is it like 2-3 years of track record with us and then they come in, or is it like 1 year and they jump into the customer?
Normally 2-3 years of track record they look forward around that side. So that happens in this category particularly. And again, I'm saying that most of these balance transfers which happens are in the tier 2 or the bigger towns compared to in the smaller places basically. So what we are seeing internal trends also, the markets where we are deep inside, we don't have any of these trends coming around. But yes, today these national bank and large NBFCs, they have a presence in tier 1, tier 2 in a very sustainable way. So they always opt for these kind of opportunities, which is easy to gather. But yes, before that, these guys has to create a track record of 2-3 years and regularly filing the ITRs and things around that side.
Perfect. This is very helpful. Thank you, sir. Thank you so much.
Thank you. The next question is from the line of Shripal Joshi from Equitarius. Please go ahead.
Hi, sir. Good morning, and thank you for giving me the opportunity. So my question was pertaining to the vintage of our branches. So in one of the slides you've shown, how the AUM of AUM per branch of our branches have been improving since FY21. So just wanted to understand, for more than 3-year branches, where do you see that number sort of stabilizing, and how do you see this 1 to 3 year vintage branches seeing the improvement on the AUM per branch? So just wanted to understand that metric and what is the scalability there.
So AUM is something which you don't feel that it has to stabilize at one point. It is a continuous journey which has to keep improving as the vintage and time progresses. For us, the stabilization which comes in the number of units each branch is dispersing. So take an example of any branch. If sustainability, it is dispersing 18 units in a month, which means approximately 200 units in a year. And if it is existing from last 7, 8, 9 years, the AUM can go to any whatever level it is basically. So it's not that it has to be sustainable to say 25 crores or 30 crores. We have branches which are with us from almost 10, 12 years. And they are fully sustainable and giving a output of around 18, 19 units month on month, and their AUM is anyway cost 60, 70 crore also. So it depends upon what level you have to take it to the branch in terms of the output and productivity. And for us, that metric is this 17, 18 units monthly disbursement. So there will be few advantages to branch. First of all, this customer is sticky, so they don't have a tendency to close loan in 1 year or 2 years of time. The expected life of customer in the system is around 6.5, 7 years. So for 6-7 years, there's a consistent growth in that side. And eventually, as we've seen that the branches which opened in 2013, when the ticket size was hardly 3.5 lakhs, has gone to 9.5 lakh rupees, that inflation factor also works on that piece. So instead of focusing on AUM, it is something like how the branch is sustainable and how monthly output they can give it. That's a metric that we measure, and that's a metric that is a realistic picture of on the ground how it has to work basically.
Got it. And so typically, how much radius does one branch cover, and at what, like, so do we have a strategy that if a branch is of certain size or of certain customer base, we split it, given that, I mean, the business in that particular geography is pretty strong, or the opportunity that's in that geography is pretty strong?
So the point is, normally when we open any new branch, we see that from the existing branch to start with, it should be around 50-60 kilometers away, basically, from the existing branch. So that, both of the branch can cater a certain fragmented geography near to them. But as the time progresses, if there is a lot of potential in that market, then we don't mind even opening one branch in between these two branches, maybe 30 kilometers, 40 kilometers away from there. So in few states where our penetration is quite deep, and there are cases where two branches are just in a range of 40, 35, 40 kilometers also. But normally, whenever we try to open a new branch, we try to maintain a distance of 60, 70 kilometers from the existing one.
Got it. Thank you, sir. Thank you so much for answering all my questions, and good luck for the next quarter.
Thank you. The next question is from the line of Jigar Jani from B&K Securities. Please go ahead.
Yeah, hi. Thank you for taking my just wanted to check this self-employed to salary that has been moving over the last 4 years more towards self-employed. Do you think this is the ratio where it will settle overall in terms of the mix, or do you see it moving more towards the self-employed side more? I have two more questions. I will ask them after this.
We are into affordable housing, and we cater the segment which is a part of LIG, largely lower income group. And the markets what we operate, tier 2, tier 3, and tier 4. So we have with time built expertise around underwriting them internally for the self-employed, and that is the reason that's a focus area for us. The kind of yields what we maintain, the kind of profile what we take up on the book, I think those expertise need to be built, and we have to hone those skills which our underwriting is able to do in last 12-13 years. So as the time progressing, the ratio of self-employed is improving. As we see today, it's around 72-73% of the self-employed book. Slowly, stability is going to go up only because that's a major, focus area also for us. Even in these markets, the salaried people will find majorly the cash salaried basis or salaried people who don't have a very secure job in that sense. But if you see the self-employed people, they have a good sustainability, they have evolved themselves to a certain level that now they can, put the equity to get their new home. And there they need the support from India Shelter, there we get a stand along with them basically. So with this thought and psychology and this philosophy, our focus is going to continue to remain more on the self-employed side. So 4 years back, self-employed ratio was around 65%. In 4 years, it has come to the level of 72%. If you see next 3-4 years, you look, it's going up to the maybe level of 77-78%.
Understood, sir. And sir, just to understand, in your presentation, you have mentioned 30 plus DPD as 2.4%. But if you add the stage 2 plus stage 3 numbers, that comes out to be 3.2%. So, can you explain what is the discrepancy, or I'm not able to understand something here?
So there is no discrepancy as such, like Jigar. So there are two functions. One is that, there is a restructured portfolio that we have done during the COVID restructuring time. So whatever, accounts that we have restructured, at that point of time, that pool was around 30 CR. In fact, over the last 2 years, this has come down to around 20 CR. So out of this 20 CR, 2 crore is NPA, which is there in stage 3, and 18 crore is there into stage 2. We have classified them at stage 2 asset irrespective of their DPD. So even though these accounts are paying their regular EMIs and all that, but considering high risk in this particular class of customers, we have classified them as stage 2 for the ECL perspective.
So the restructured book is in stage 2, which is why it is higher.
Yeah, and now they have a decent track of more than 18 months where they are paying regularly.
Right, sir. And on the co-lending side, Given that we are now started it last year and we are building it up, what impact do you see? Do you see any impact on yields? Because I'm presuming this would be at lower yields than what you would normally do, because with banks you will be doing higher ticket sizes per se. Or is it at similar yields as compared to your normal book?
So even if we do, slightly lower yield to the customer and customers, even in that, in our share of like co-lending, we will get a higher proportion of yield. Because our agreement with the co-lending partner will remain in the range of 9% handle, and even if the ultimate customer is getting slightly lower than what we are currently offering, we will make higher yield on 20%. So that will not impact our yield downward side.
Okay, understood. And sir, lastly, could you share the 1+ number if you share?
Our 1+ remain in the range of 4 to 5%. In the March 2024, it was at around 4.2%.
4.2.
Yeah.
Yeah. Okay. Thank you. That were all my questions. Thank you so much.
Thank you. The next question is from the line of Shubhranshu Mishra from PhillipCapital. Please go ahead.
Hi, good morning. Thank you for this opportunity. I just wanted to understand the split of the LAP and home loans into salaried and self-employed. And again, if this can be given in tier-wise, because the slide gives the complete mix. So how do we look at home loans and LAP with each of these individual things? And secondly,
Sorry, Shubhranshu, to intervene. Can you, your voice is echoing. If you can just,
One second. Yeah. No. Is this better?
Yes, please continue.
Sure. So if this split of LAP and home loans can be given in terms of salaried and self-employed and the tier of cities. That's the first question. The second is that though we speak about own sourcing, if we look at our cost to income or OPEX to assets is too high at around cost to income is at around 45%, OPEX to assets at around 4.5%. So what's going inside that OPEX that makes it so high if we are sourcing on our own? The third question is that what are the various risk management tools that we are taking at the onboarding for LAP? Because if we are doing lower city LAP, the liquidity of that property remains low. And given the fact that the ticket size is low, we can't invoke SARFAESI. So is there a mix of income levels, industries, if we can speak about that in LAP? Thanks. These are my three questions.
So, Shubhranshu, we are a housing finance company, and housing finance company have a SARFAESI rights from 1 lakh rupee onward, basically, right? So, yes, other financial services, which include NBFC and all, that starts from 20 lakh rupees. But particularly housing finance company have this advantage of having SARFAESI tool at 1 lakh rupee, basically. Now coming to the next question, our loan against property ticket size remains around 9 to 10 lakh rupees. Here we look for a properties which are purely a self-occupied residential property. So on our book, there are more than 99% SORPs, what we call self-occupied residential property. And there again the LTV which stand is in tune of 45-46%, which is lower than 50% even, right? Most of these customer for us, they are self-employed. In fact, for loan against property, the customer which are with us is more than 90%, 95% which are self-employed. Salaries are normally which we are coming on book is for the home loan requirements, not for the LAP requirements. And there, when you see the ticket size of 9-10 lakh rupees, LTV of 45% and the property of SORP, the most of them the end use is, whatever the small requirements they have. And here they can have requirements not only for business, sometimes they require the money since they have a sustainable business also, for consumption loan also, sometime in marriage or sometime, for sending kids around. But that portion is also very, very low. So most of them, if you find, this is into the business expansion on that side. with the self-occupied with 45%, and these are the important risk parameters. And we do have a assessment where every customer is being met at his premises of operation, where he's running a business, as well as his property which is offering around that side. Any customer which we disburse before that, there are at least 4 touch points at his premises, and then on basis of the evaluation, where we try to capture at least 70 to 80 points, which gives them information about the customer before the evaluation. Then on basis of the DRE rules, what that gives the output, the customer sanction is given. So this is a blend of touch with customers as well as using the technology, some usage of data science and scorecard, and giving the credit norms which help us out into that piece. And that's the reason if you have seen the trends of the delinquency of India Shelter from last 8-10 years, they are sustainable, though we are in the same business from last 12 years.
And your question of OPEX to AUM is higher. So there are, two functions. One is obviously scale. So as we, grow in terms of our scale, you see that, our OPEX is coming down. Secondly, since we are in the business of direct origination, our cost is in the form of salaries that we, give to our loan officers, our branch peoples and all that. So whatever, salaries we give, those salaries come into our P&L. While in case of, prime housing, whatever origination they do through DSAs and all that, all those costs get amortized over the tenor of the loan. So, this is a challenge in affordable housing where, income, upfront income that you get, that get amortized and your expenses come into your P&L. But, so that's a business nuances. Over the years as we scale, our OPEX will come down.
Understood. And if I can just squeeze in one last question to our guidance of 35% growth, that's on AUM. So, ballpark 6 to 7% should be inflationary growth in terms of ticket size. There should be some amount of growth with some degree of our branches maturing and breaking even. So that should occupy almost 10-12% of the growth. So balance is on the actual organic growth is somewhere closer to 20%. Is that a fair understanding?
Well, if you see our ticket size has not grown for last 3 years. In fact, that remains empty of 10 lakhs or something that way. So that inflation is not overnight, which happens 6-7% year on year. That is not we are into business of. We are catering the set of customers who are purely affordable and they require a loan to make sure that they have a home or create a mortgage around that side. So we don't look growth keeping in mind these aspects of just increasing our ticket size. We ensuring that we have a more number of customers on book. And that is the reason whenever the question is being asked on the AUM side, and our answer and representation is more on that how the productivity can be improved in branch and how we ensure that the branches go to the level of 17-18 units a month basically. So what we indicate is something which has to be given surety that this is a number that we are intact on. And if we meet this number, go beyond that or around that piece, I think it's a matter of execution, which, as we progress, will keep giving the output on that side.
Sure. Thank you.
Thank you. The next question is from the line of Omkar Kamtekar from Bonanza. Please go ahead.
Hello. Am I audible?
Yes.
Hello, am I audible? Yeah, thank you.
Yes, you're audible.
So the first question was with respect to how the branch addition will happen. So we just told in the presentation, we have 15 states that we are present in. So are we going to go deeper in these specific states where the vintage is higher or say 3 years or more, or are we going to expand into more states? And which specific region are we looking at? Are we looking to expand northwards towards maybe UP further and increase our percentage of AUM there, or we go southward where the income profile of the applicants is much better?
So Mukeshwarji, we have to open these 40 to 43 branches across country, and only in these 15 states. And the penetration, where we feel the demand is, picking up quite well. Instantly, we can rectify that thing basically. So these branches will be, expanded across, starting from South, Rajasthan, MP, and some part of North also. So if you see between 15 states, if you see average of each state will not be more than 3 or 4. That is the number of branches you can open. But yes, in few states we'll be opening maybe up to the 4, and in few states we will restrict to the 2 or 3 level basically. So if you talk about particularly the ratio between them, then this year I think a number of branches which will be opening in South will be little more, compared to the rest states if you go the state by state particularly. But otherwise, we are opening across country these 42, 43 branches.
Understood. And with respect to the AUM breakup, 50% of the AUM is coming from tier 3 cities. So it looks like we are making a conscious effort to go deeper into the more rural and inner parts of the country. So is this fair to assume that as we go deeper, this will go further higher, and as a consequence, maybe the yields might also jump up because because the riskier profile of the applicants there, the yield might also go up.
The point is, for us, tier 3 is not a rural. These are the towns, places, and most of them are district headquarters also where the population is more than 2 lakhs, basically. So for me, Kishangarh is a tier 3. For me, Alwar is a tier 3. So these are not a rural markets. Their economy is booming up, and numbers are intact. Property rates are quite decent, and you get a customer where they are looking for the getting a house of in range of 18-20 lakh rupees and looking for the loan of 10-12 lakh rupees. So this is not a rural segment particularly, and they're quite conscious about what is the loan and what are things around that side. So our thought is to maintain the spread of 6% and maintain the quality around that side instead of pushing for high yields and taking the risk which we feel that we don't want to build appetite around that side basically. So penetration is going because this is the markets which are getting developed more than the rest of the country. So if you see the growth trajectory which is coming in tier 1 market, I think you will find the growth in tier 2, tier 3 or beyond is much better and much progressive.
Understood. And finally, with respect to the buckets, which specific buckets? So we have our peers, some who are specifically concentrated on the sub 10 lakh, some are specifically targeting the 15 to 20 lakh bucket of applicants in the affordable housing segment. What is our target range of applicants that we're trying to see? Because I can see the share of the 5 to 10 lakhs is increasing very steadily, and even 15 up to 15 lakhs is also increasing. So is there when we see the largest amount of growth both on AUM side and on volume side?
So our maximum focus remains between 5 to 25 lakhs, and out of that you are absolutely right that 5 to 15 had a more concentration because our ticket size stands around 10 lakh rupees. So this is a segment, which we cater, which, it comes and fit into our bill very in right fashion. And we want to continue around that side. With time, if inflation goes up and this category inches up towards from 10 to 11 or 12, that is a progressive journey around that side. But what is current state of affairs? 10 lakh is a, average ticket size that we keep running around.
Understood. And just on the co-lending side, a small clarification. How much of the total AUM do you see envisaged, say, over 3, 4, 5 years, the co-lending business to contribute to the total AUM? Do we have something in our minds with respect to that?
I think we just start, building this book. It's too early that you have to depend upon as a part of your, entire AUM percentage in that sense. We have to test. We are with certain banks which we have tie up, and we are just trying to understand how the synergies are getting built. So this is too early to give an output in terms of that this is the kind of percentage we want to maintain. But if this business is picking up and giving the right output for us, then definitely we will not shy away from it.
Understood. And finally, just on the NHB spread, what is the spread that we get? Because some of our competitors, from what I have seen, get what they get funding from NHB is approximately 5 to 5.5% for their funds, and they get approximately a 5 to 5.5% spread, that is GSEC plus 30 bits. So what is the spread that we occupy on the NHB funding?
So, NHB has, two schemes. One is the regular refinance scheme. Another is affordable housing finance scheme. So on regular refinance scheme, you can see that fund is coming at around 8%, wherein, you lend and you make margin of around 550 to 600 basis point. Then there is affordable housing finance scheme, wherein funding comes at around 5.5%. But there is a cap on lending, wherein, you generally end up lending at around 10.5%, 11%. So at the end of the day, you make similar spread on like both the schemes. So technically, it doesn't matter that whether you are drawing in affordable housing fund, regular housing finance, once your P&L remains broadly similar.
Understood. So 500 to 600 basis point would be the range overall. So it's not a material difference between the two.
Yeah.
Okay. Understood. Thank you.
Thank you. The next question is from the line of Vignesh Iyer from Sequence Investment. Please go ahead.
Congratulations on good set of numbers and thank you for the opportunity. My first question is related to what is the total co-lending that is as percentage of AUM as of now, and what is the percentage of the AUM we have an internal estimate maybe 3 years down the line that we are looking on for the co-lending part.
So, as we have said, so at this point of time, co-lending is at evolving stage. So at this point of time, AUM is, closer to around 2% in this co-lending. And, as we progress, we have a better experience with our partners, their policies and all that. We can give a guidance at a later date on this.
Okay. So, but can you tell me which are the banking tie-ups or other tie-ups that we have for co-lending as of now?
So we have 2 tie-ups, wherein, one is private bank and another is PSU bank, that we are doing at this point of time. And that is primarily for loan against property. Home loan is something which we are doing on our own book entirely.
Okay. Sorry, I missed the part. Sorry. It is for which property?
So loan against property is something which we are doing in co-lending, like as a product, and home loan is something which we do entirely on our own balance sheet.
Okay. Got it. And on the ROA part of it, what is the steady state ROA that we could achieve, like say 3 years down the line? 2-3 years down the line.
So at this point of time, you will see, ROA in the upward of 5%. But, at this point of time, we have recently raised our equity, so benefit of equity is coming. So as we, reach to a leverage of 3.5 times, broadly, we expect that ROA will stabilize to around 4%.
Okay.
And that is a steady state belief.
Okay. So debt to equity as of now, after raising the fund, the debt to equity is quite at a very good level, and we've got quite a headroom. What is the amount of debt to equity that we are comfortable reaching up to, say, 4.5-5 times of the book?
So, at this point of time, we are at around 2.5 times of our debt to equity. And given the discussion with the bankers, rating agency, we believe 5 times is also quite achievable. But that's a long journey. Even for reaching 3.5 times will take around 18 to 24 months from here. So it's a journey that will keep evolving.
Right, sir. Okay, sir. That's all from my side, and all the best for you.
Thank you. As that was the last question for the day, I now hand the conference over to Mr. Rupinder Singh for closing comments.
Yeah, thank you everyone for taking your valuable time for attending our earnings call. We will keep you posted for any other further updates. Also, audio recording and transcript of this call will be uploaded on our website shortly. Looking forward to hosting you all in next quarter. Thank you so much. And if you have any further questions or require additional information, please feel free to reach us out. Thank you so much. Thanks once again.
Thank you. On behalf of ICICI Securities Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your line. Thank you.